And joining me now with more on what this election means for markets is Sam Stovall. He's a chief investment strategist at CFRA. Sam, it's great to have you, especially on a very important day. And let's dive right in. What does matter most to markets when it comes to this election?
Good morning, Kristen. Well, basically, I think that the markets are looking for a split outcome, meaning that they would like to have the president be of a different party from either house of Congress. Usually, as goes the presidency, so goes the House. And it looks like that might be the case this time as well. But I think that because both candidates have proposals that will likely increase the debt level, increase the likelihood that inflation will take longer to go down to the 2% level. I think most people would like to see a split Congress in the end.
We had seen a very strong run for stocks. Of course, the second year of this bull market up more than 30%. The S&P and the Dow having their strongest weekly win streak of this year. That wrapped up in early October, and we've seen some give back. Are investors pushing pause as we wait to see how these results play out?
Yes, I think they are, because when you look to the daily trading going back to World War II for each of the elections, looking at the day before, you see a slight positive move the day of the election, ditto. But then the few days afterward, Wednesday, Thursday, Friday following the election, we tend to see the market decline on average. Certainly this time will be no different, probably even more magnified, because we won't know until Thursday, Friday, or even next week who the actual winner was. So Wall Street does not like uncertainty, and not surprisingly, therefore, November has been the most volatile month of any election year going back over 21 elections.
Yeah, we didn't see much volatility in September, maybe a tiny bit toward the end of October, Sam. How could these possible election outcomes impact stocks into year end?
Well, I think that until we find an ultimate winner, volatility will certainly be present. However, history says once the uncertainty has been lifted, no matter who gets elected, then Wall Street tends to focus on the future, and the market does tend to advance, with all sizes, styles, and sectors posting average positive returns.
Well, we see the S&P 500 up about 20% year to date. Is that typical performance that we would see for this index during an election year?
Absolutely not. It's much stronger than we have traditionally seen. Usually an election year is a good year. The third year of the four-year presidential cycle is by far the best. The presidential election year is not bad itself, but we did get a pretty good indicator early on this year because it was election year and we saw the market up in January. 100% of the time that has happened, the market was higher, and the average gain was 16%. And this year, we've even surpassed that.
So we've seen growth slow down a little bit, Sam. Certainly the GDP numbers have indicated that, but consumer sentiment remains strong. What is your expectation as we enter what is well known on Wall Street as the strongest 6 months stretch that does run from November through April?
Well, you're absolutely right. November through April is the strongest 6-month stretch, going back again to World War II, not only in average price change, but also in frequency of advance, sort of like a batting average of positive moves. Traditionally, we have seen the best performers be the more cyclical sectors like consumer discretionary, industrials, materials, and technology. And I think that this time around we'll probably end up seeing the same because earnings are expected to be advancing in the mid-teens in 2025.
So it sounds like, Sam, even though we could see some volatility throughout November, it doesn't necessarily sound like investors should be bracing for wild gyrations in stocks this week. Is that right?
Not wild gyrations, certainly, but some slight movements up and down during the day. But I think what you're also asking is, should investors essentially be sitting on their hands? Don't let their emotions become their portfolio's worst enemy. And I would agree wholeheartedly with that.
Yeah. So I want to talk about what can fuel growth going ahead. Obviously, we need to see how the balance of power shakes out in Washington. And based on what you're telling me, gridlock is the ideal scenario. But as these corporate earnings continue to come in and we await that Fed decision on Thursday, what is going to take stocks higher and continue this bull market?
Well, I think you hit the nail on the head when you said interest rates, because obviously the market does very well when the cost of capital is lower. Our expectation is that the Fed will cut rates this week by 25 basis points. We'll cut again in December, and then four more times in 2025. So taking a moderate approach to easing their interest rate cycle, that should lead to about 14% earnings growth in 2025, a similar number for 2026. And if we also remain, in a sense, the best house on the block when it comes to global stock markets, I think that would be beneficial as well.
And just to be clear, of course, we've heard Fed Chair Jerome Powell say many times that the Fed is independent of the Oval Office. How this election day plays out in America, do you anticipate that that would have any impact on that Fed decision on Thursday?
Well, there have been 8 times since World War II that the Fed did make a rate change in the July through October period leading up to the election. And only in 2 of those times could you remotely say that it had an impact on the election itself. So in general, I would say no, the Fed typically does like to exert its independence, but in the end, it really had no impact on the election.
Sam, it's great to have you on the show. And with stocks opening with sort of a muted reaction at first, what do you anticipate could unfold in today's session?
Well, Kristen, I think that we'll probably see a very tight trading range with the market swinging positive and negative, because really nobody knows what the outcome is going to be. Certainly not today. Maybe get a better feel after the market is closed later today, but really no conclusion to this whole election until the latter part of this week.
And in terms of which sectors might be impacted most by the results, Sam, which ones are on your radar?
Well, should we get a Harris victory, the positive groups are likely to be your healthcare insurers and hospitals, because they would continue to benefit from an extension of the Obamacare subsidies. The electric vehicle, auto manufacturers, the energy areas where it's clean energy producers like wind, solar, geothermal, and also apparel retailers, because the lack of a tariff wall being erected, as the re-election of President Trump would imply, would be beneficial to these apparel retailers. The large banks, however, pharmaceuticals, would probably end up being hurt under a Harris presidency because of adoption of Basel III with the banks, more regulation in terms of drug prices from the pharmaceuticals, and also essentially just more regulation on industries. Flip side is what you would get with a re-election of Donald Trump. The large banks, pharmacies, as well as natural gas companies would do well because of the lifting of the halt on LNG exports.
Interesting. Now, I want to ask about the economy, because I had seen a story in the Wall Street Journal in the past week, Sam, that said that economists think that Kamala Harris's economic policy would lead to more growth, whereas voters, the average Joe, might think that former President Trump could lead to more economic growth. Do you have a take on this?
Well, our feeling is that if we're going to be seeing tariff be President Trump's favorite word, then that could certainly halt or at least slow a lot of global trade. In many ways, reminds me of the Smoot-Hawley tariff of 1930 that many can point to say contributed to the global recession/depression. So if we end up picking fights with all of our trade partners, that would not be a good thing. Also, the independent parties have estimated that a Trump policy would add $7.5 trillion to the deficit and debt, whereas under a Harris administration, it would be about half that. So still, both would be adding stimulus, adding subsidies and whatnot that will be increasing the debt, which is something we would have to address down the road.
Sam Stovall, great to get your take, especially on this historic day as we wait to see how it plays out in America. Sam's a chief investment strategist at CFRA.